Averaging down, a strategy that seems like a smart move at first glance, has long been a topic of debate among investors. Richard D. the Wyckoff delves deep into the pitfalls and occasional merits of this approach, offering a measured perspective. He begins by addressing a fundamental misconception: while averaging down lowers the average cost of shares, it often leads to a dangerous increase in exposure to a declining stock. It's a strategy that demands more than blind faith. It requires precision, analysis, and judgment. Wyckoff draws a crucial distinction between traders and investors. For traders, who operate in the fast-paced, short-term world of market fluctuations, averaging down is rarely advisable. It violates the golden rule of trading: cut your losses early. But for long-term investors, there may be cases where averaging down is warranted. If they have thoroughly evaluated the stock's fundamentals and are confident in its intrinsic value, a price drop could present an opportunity. However, Wyckoff is quick to caution that this is not a decision to take lightly. One of the greatest risks of averaging down is what Wyckoff describes as throwing good money after bad. Many investors double down on a losing position not out of logic, but out of hope or fear, hope that the stock will recover and fear of admitting a mistake. This emotional reaction, he warns, can lead to catastrophic outcomes. It's not enough to assume a rebound is inevitable. Instead, investors must ask themselves, is this stock truly undervalued, or am I clinging to a faulty thesis? Wyckoff underscores the importance of understanding a stock's intrinsic value. Averaging down might make sense if the stock is fundamentally sound and undervalued, but how many investors truly have the skill to make that judgment? Most simply rely on misplaced optimism. Hope, Wyckoff reminds us, is not a strategy, it's a trap. Wyckoff urges investors to focus on preserving their capital rather than trying to salvage a bad trade. He advocates using stop-loss orders or predefined exit strategies to limit potential losses. It's better to take a small, controlled loss and move on than to watch your resources dwindle further. Another key point Wyckoff makes is the danger of emotional attachment. Investors often fall in love with their ideas about a stock, refusing to let go even when all signs point to trouble. This is where discipline comes into play. Capital preservation should always take precedence over pride or sentimentality. Interestingly, Wyckoff flips the concept of averaging down on its head by promoting the idea of averaging up instead. Rather than adding to a losing position, he recommends adding to winning ones. When a stock is performing well and aligns with your original investment thesis, doubling down can amplify gains. This strategy, Wyckoff argues, is more in tune with the momentum of the market and avoids the trap of sinking more money into underperforming assets. Market conditions also play a critical role. Averaging down in a bear market or against the broader trend is particularly risky. Even fundamentally strong stocks can lose value in such an environment, leading to further losses for investors who ignore the bigger picture. Wyckoff stresses that timing and context are everything. Knowing when to act is just as important as knowing what to do. In the end, Wyckoff's take on averaging down boils down to a simple yet powerful conclusion: avoid blind faith. While there may be scenarios where the strategy works, it should always be approached with caution, supported by rigorous analysis and an understanding of the stock's fundamentals. More often than not, he argues, it's better to admit a mistake, cut your losses, and redirect your efforts toward better opportunities. Wyckoff's insights challenge the conventional wisdom that averaging down is a guaranteed path to recovery. Instead, he presents it as a tool that, if misused, can cause more harm than good. His advice is clear: be disciplined, prioritize capital preservation, and let logic, not emotion, guide your decisions. For those willing to heed his warnings, the stock market can be navigated with greater confidence and success.